Last week, former Dallas Fed President Kaplan, former as in he can tell the truth, gave an interview saying, quote, "We are now headed into the third phase of the bank crisis." Right on cue, fresh money market numbers popped out showing the biggest jump in money draining out of banks since the very first week of the bank crisis way back in March. It was a fairly dire number, $47 billion on the week, to a record high of $5.4 trillion currently parked in money markets. For scale, that's about a quarter of all the money in all the bank accounts in America. And it's up almost $1 trillion in the past year, half of that in the past 2 months alone. So the bank runs may have dropped out of the headlines, at least temporarily, thanks to trillion-dollar pre-bailouts, but they appear to have metastasized into a grinding flood, a bank walk, out of especially regional banks that's currently running $8 billion per day. By the way, at an $8 billion daily drain, the entire banking system outside the Big Four would shrink by half in roughly 2 years. And that brings us to Kaplan's third phase. Essentially, banks are in trouble already from losses on their assets, their bonds, their loans, all thanks to reckless Fed hikes. And banks are now realizing that more trouble is coming from the slowing economy. The problem, according to Kaplan, is that banks cannot raise new money to plug their balance sheets since investors are afraid to buy bank stocks, meaning the regional banks' only way to plug their holes is to shrink their loan books. That means slashing new loans, stop renewing existing loans, or even calling in loans. All three hit the small and medium businesses the hardest because regional banks are their lifelines. The mega banks generally do not bother with the little guy. After all, it's a lot easier to make $1 billion loan to a Fortune 500 company or even to jet off to Mexico where American taxpayers will bail you out than it is to soak up that billion in thousands of family business loans. That low-level scut work they leave to the regional banks, who are now failing. Kaplan actually came out and blamed the Fed, remember he's a former president so he can speak freely, for draining the regional banks to, his words, too big to fail banks. And he noted that further hikes, which the Fed is currently promising, will deepen the squeeze both on small banks and on these small businesses who need them to survive. Put it together and you've got banks desperately trying to shrink fast enough to outrun the reaper, and they're using small business and households to do it. The big boys will get all the money they want. And so we are now at that dangerous, quiet stage where the headlines are quiet, even as the trillion-dollar moves accelerate under the surface. Every day that passes, the regional banks are getting smaller, the small businesses are getting cut off, bankruptcy numbers are already telling us they're dropping out one by one, and when the crisis muscles its way back into the headlines, we can expect them to fall in droves. At which point, perhaps we get to that fourth stage of the crisis when Wall Street bankers have to lay off the butler and figure out how the washing machine works. Okay, we'll be watching. See you next time.